If you've looked at the housing market recently, you've likely seen the shift. You do the math on a standard home, factor in the current interest rate, and find the monthly payment has moved entirely out of reach. This financial squeeze is a precisely engineered event, orchestrated here by the central bank. They are executing a policy known as quantitative tightening. Quantitative tightening, or QT, is the process of a central bank reducing the money supply to slow down economic activity. This cost of living spike marks a giant, invisible financial lever being pulled on purpose. To understand how this works, imagine the economy as a farming valley. Money is the water keeping the crops alive, and the central bank operates the dam that controls the flow. During recent crises, the central bank opened the gates to flood the system with water through quantitative easing. Quantitative easing, or QE, is a policy where the central bank creates money to buy assets, injecting cash into the economy to encourage lending. The crops survived, but the valley eventually flooded. That excess water is the inflation making your groceries and gas more expensive today. To protect the valley from inflation, the central bank must now run the pumps in reverse. To lower the water level, the central bank reverses the mechanics of the last decade. Previously, they pumped cash into the economy by purchasing government bonds from commercial banks, trading liquid cash for paper assets. Quantitative tightening reverses this. The central bank takes those accumulated bonds out of their vault and sells them back to the open market. When commercial banks buy these bonds, they pay for them by draining their own reserves, sending liquid cash back to the central bank. Once the central bank receives this cash, they lock the vault, effectively deleting that money from the circulating economy. By locking the vault, the central bank vacuums cash out of existence to shrink the total money supply. Those abstract bonds are real-world government debt and treasury notes, which the central bank treats as the equivalent of cash. Selling this debt results in liquidity reduction. Liquidity reduction is the process of decreasing the amount of easily accessible, spendable money available in financial markets. Because the central bank vacuumed up the cash, retail banks now have smaller pools of money to operate with. This low liquidity environment dictates how carefully banks must guard their remaining cash. This strain connects directly to your wallet. With less cash on hand, banks have less money available to lend for a car or a home. When cash is scarce in the banking system, it becomes more valuable and expensive to acquire. This scarcity is the mathematical reason your auto loan and mortgage rates have climbed. The bank is charging a premium because their own supply of water is running low. High borrowing costs force businesses and consumers to halt their spending. As consumer demand falls, inflation begins to starve and prices finally cool down. High interest rates and slower growth show the giant vacuum of quantitative tightening working as designed to restore balance.
Share, like, comment, and subscribe.